Welcome to the Aviation Insurance Podcast, the podcast that helps aircraft owners and aviation businesses learn and understand the complex world of aviation insurance and risk management. From the basic principles of aviation insurance to risk management techniques and updates on the aviation insurance market, the Aviation Insurance Podcast is your guide to traverse the world of aviation insurance. Now, here's your host, Tim Bonnell.
Well, welcome to the Aviation Insurance Podcast, where we've been discussing the fundamentals of aircraft insurance. And today, I want to talk about a little bit broader concept, one that certainly affects aviation insurance, but one that really affects all lines of insurance. People often wonder why claims that have nothing to do with their business impact the rates in their class of business. In fact, most people think, based on years of having their own auto insurance, that, hey, if you have a claim, your premium goes up. And if you don't have any claims, your premium shouldn't change. And unfortunately, there's a lot more to it than that. And one of the reasons is how insurance works. Insurance ultimately is about the law of large numbers. The premiums of many are made to pay for the claims of a few. While you think you may be not be one of the few, it does happen even to the best of operations. So that's why insurance is important. So the losses of a few are paid for by the premiums of many, the law of large numbers. So one of the other concepts about insurance is the spreading of risk. So one insurance company is not going to take on, an airline risk by themselves, or a large business jet with, a $60-70 million insured amount or whole value and $300 million in liability limits. That would be a very large loss to one insurance company. So insurance companies, especially in aviation, spread the risk that they have among other insurance companies. So you may be purchasing, that $60 million Gulfstream, 550 insured amount policy with $300 million liability limits with Company A, but Company A is going to turn around and then what's called reinsure a portion of the risk they wrote with other insurance companies or a reinsurer. So they spread the risk by reinsuring a portion or a certain amount of the risk, and that's the concept of reinsurance. Then reinsurers end up going and reinsuring a portion of their book, and that is how risk is spread. That is how natural disasters can impact aviation. That's how aviation can impact non-aviation lines when there are severe losses, because losses are spread among many insurance companies. So that's how, while you may not have had any claims, your category of operation or the aviation or aerospace industry had a lot of claims. For instance, we've talked about the Boeing 737 MAX losses that had the two airlines, Ethiopian and Lion Air, but it also had the grounding claims for all of the airlines who had their aircraft they'd purchased grounded due to the maintenance issues. The combined loss reserves for that loss was $2 billion, which was the majority of the premium collected worldwide for aerospace risks. Fortunately, that was spread out, but it certainly caused some major issues for aerospace. So while you may not have had any claims in the last year or two, certainly aviation's been negatively impacted because of the spreading of risk and reinsurance. So reinsurance happens when multiple insurance companies share risk by purchasing policies from each other in order to accomplish several things. So a couple of benefits of reinsurance for everyone: it reduces volatility by leveling out bad loss years because the risk is spread. It increases the underwriter's capacity. It allows them to take on higher whole values, as we talked about with that Gulfstream example, and higher liability limits. Insurers have to retain certain levels of reserves in order to pay for the losses they write. And without reinsurance, that would be very difficult, especially for aviation. It increases the diversification by allowing insurers to take on risks in various other classes that are outside of the comfort zone or in geographic territories they wouldn't otherwise write. And ultimately provides that protection against the catastrophic loss, that one loss or two losses that happened to happen one year that would have devastated the insurance company's reserves and put it into financial challenges. So reinsurance addresses those issues and helps insurance companies have some predictability and to sustain operations when a large catastrophic loss or a large number of losses happen in a short period of time. So there's two ways that reinsurance is written, and we will get into that in the next episode of the Aviation Insurance Podcast. So until next time, enjoy clear skies and unlimited visibility.
Thanks for listening to the Aviation Insurance Podcast. If you found this episode of value, please share it with someone who would benefit from this information. Don't forget to subscribe in your podcast player so you don't miss any new episodes, and to help our show have more impact. This episode is brought to you by Aeris Insurance Solutions, your flight plan for navigating the turbulence of aviation insurance. For more information, visit aerosinsurance.com. That is www.aerisinsurance.com. Disclaimer: these episodes are for educational purposes only, and due to the changing regulatory and legal nature of the business, some information may change over time. Having a well-educated and experienced aviation insurance broker on your team is an absolute requirement to success in business and for managing your aircraft and aviation business risks.